If you invested $10,000 into SoFi stock in 2021, you would have just $4,461 today. That is, if you invested that money on January 1st, 2021, this is what you would have left today. So, how did this stock get here? I'm going to give my opinion and support it with some financial metrics in this video. So let's get started on that. If you look here at the chart of SoFi Technologies total return starting in January 21, it got off to a hot start with the stock rising over 60% in a short while. But then it began its downward trend, and that worsened in 2022. And in 2023, it started off hot and it got a little bit of a boost, and then it's been on the way down. And this recent banking crisis with SVP and the FDIC needing to come in and step in and support the regional banks and all that, it's not good for SoFi Technologies, right? Even though it might not be directly exposed to whatever's going on with SVB, it's still a bank, and bank stocks have gotten hammered, absolutely hammered, in the last week and a half or so. So, if you look at SoFi's revenue growth, you would think the company's stock price has done exceptionally well, right? You look at let's say between the start of 2021 and revenue growth of over 100% to begin with, and then one downtick. But then starting from January 2022, every quarter has consistently delivered over 50% revenue growth. Look, this is the mark for 50% revenue growth right there. And this is SoFi's actual revenue growth each quarter. And every quarter, it's been above 50%. So that's exceptional growth, especially for a bank stock. You don't see bank stocks growing at this rate. So this is excellent growth, but it's easier, I should say, to grow your revenue if you're losing money on the bottom line, if you're willing to lose money on the bottom line. And that's something that most banks are not willing to do. You look at most bank stocks, they are profitable. They are profitable, especially the bigger banks. You look at the bigger banks, they're all very profitable, generating billions of dollars in net income and being conservative in terms of their customer acquisition costs. That's not the case with SoFi Technologies. SoFi Technologies has not been conservative in their customer acquisition costs. They're willing to spend a little bit of money to get customers, to attract customers, because they're relatively new and they know they need to offer some reason to get customers to switch over from the Bank of Americas and the JP Morgan Chase and the Citibank and the Wells Fargos of the world, right? They need to offer you something to get you to switch over, right? Once you're with a bank, it's a major hassle to switch to another bank. You've already got direct deposits set up, your online payments are already set up. Switching that over is time consuming. So you wouldn't do that for a small incentive, right? You would need a major incentive to switch over. And that's what SoFi has been doing. SoFi offers you a direct deposit rate. I'm sorry, not a direct deposit rate, but a checking account or a savings account rate that is higher than nearly every bank out there today. And especially if you compare it with like Bank of America, which gives you like, very low APR for saving your money with Bank of America. SoFi at over 5% last I checked was a significant, or over 4.75% last I checked, is significantly better than Bank of America, right? You put your money with SoFi, your money is going to earn you a decent return by keeping it at SoFi instead of keeping it with Bank of America. And so that's been a major incentive to get people to switch over to SoFi. However, that's also a major expense. That's also a major expense. SoFi has to pay their depositors that interest expense every quarter. They got to pay it, right? Whereas Bank of America doesn't have that major expense on its operating expenses. So here's how that's been impacting the company. Look at the SoFi's earnings per share for the trailing 12 months. Negative, 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 negative every quarter. And getting better. That's something to its credit, right? It's been getting better. In the July trailing 12 months ending July 2021, the company lost nearly $4 of earnings per share. That's been getting better. In the most recent update trailing 12 months, the earnings per share loss was just 40 cents. Just 40 cents. However, again, take that with a grain of salt, because I will show you one reason why SoFi's earnings per share has been improving. That's not necessarily a good thing. That's not necessarily a good thing. Okay, I'll show you that in a minute. But first, if you look at just net income for the trailing 12 months, it has been improving, but not as much as the earnings per share has been improving. Again, net income fell all the way down to 480 million at the trailing 12 months ending in January of 2022. That's improved to a trailing 12-month loss of 320 million in the most recent update. So a 33% improvement in terms of the net income loss. Not as significant as the earnings per share improvement, right? They went from nearly $4 to 40 cents. That's almost a 10x improvement versus just a 33% improvement in the net income. And here's what explains that difference. SoFi, this is SoFi's average diluted shares outstanding. So this is how many shares the company has outstanding. Okay, it went from around 200 million all the way up to 900 million between 2021 and the most recent update. So in 2021, there were only, let's round it up. Let's say there was only 200 million shares outstanding. Now that went to 900 million. Why is that bad for SoFi stockholders? Well, this is why. When the company eventually turns profitable, or if it eventually turns profitable, it's going to need to split the profits between more shareholders. So if SoFi generates, let's say, $1 billion in net earnings, net profit in 2024, that's going to need to be split among 900 million shareholders. So everybody's going to get about $1 in earnings per share. Every shareholder, every share is going to be entitled to about $1 in earnings per share. Had they not diluted, had they stayed at 200 million shares outstanding and they generated $1 billion in net income, then every share would have been entitled to $5 earnings per share, right? So now you're going with the same $1 billion in profits, you're going to $1 in earnings per share instead of $5 in earnings per share. Look at that massive difference in the percentage of profits you get as a stockholder, right? So if you've been a stockholder of SoFi, let's say you bought the stock in 2021, your stock has been diluted nearly fivefold, okay? So this is not a good thing for investors. This is not good for SoFi shareholders. And this explains why the earnings per share losses have been decreasing. Because just as the same way as the profit per share decreased, it's the same way for the loss per share. So the loss per share has been split among more shares, and so that decreased the amount of the loss per share, but not necessarily all for good reasons, right? They did reduce the net losses on the bottom line slightly, but not as much as the overall loss per share. And so these are all factors that have SoFi's stock price falling by so much, by over 55% over the last couple of years. And I know some of you might be asking, well, is that a buying opportunity? is that a reason to buy the stock right now? And to answer that, let's look at SoFi stock's valuation. It's trading at a price to sales forward of 2.049. It's the lowest it has traded for, according to this metric, going back all the way to January of 2022, when it was trading at a price to sales of over 6. So whether or not this is a buying opportunity is clouded by the recent volatility in the banking sector as a result of the rising interest rates and fears of a recession due to inflation. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. This is not a time, in my opinion, to be buying a stock like SoFi. There is too much uncertainty, too much volatility, too much risk surrounding it. On top of the fact that the company's already losing money, diluting shareholders, having an expensive time bringing customers over and attracting customers. So the company had its own problems even before all of this volatility in the banking sector, and now you add that to the mix. I don't know. That's just too much risk for me to tolerate, and given the potential reward for investing in this stock, I would say right now it's not a buying opportunity. I would wait, let the dust settle, and then once the cloud clears and SoFi is in the clear and the banking sector is in the clear, then you can start to consider investing in SoFi stock, but not just yet. That's, of course, just my opinion. All right, that's all I've got for this video. Thank you for watching. If you like this one, I'm going to add a couple at the end of this video that I think you'll enjoy. Please click on one of those, and I'll see you over there.